right. Good afternoon, everybody. Uneducated Economist here. Actually, it's probably the evening for most people, isn't it? Good evening, everybody. Uneducated Economist here. So, in today's video, we are going to be talking about how the Federal Reserve is reacting too slow to the economy and how things are absolutely going to get destroyed because they are now too late. Now, this is something that I think Donald Trump and the administration would like to push for their idea of what it is that's going on with monetary policy. However, if you were to understand monetary policy for the reality of what it really is, explained from the Federal Reserve, this is not outside of what it is they want. Like, they are actually right in line with everything that they had said that they were going to do. So now I'm just going to kind of briefly read from the article. So, oops, let's get down there. There we go. So ultimately, the headline says Powell may have a hard time avoiding Trump's too late label, even as the Fed chief does the right thing. Now, I'm not exactly sure what they believe the right thing is, because right or wrong, it's all about the decision that you have made and the position that you have taken. So there is no right or wrong. It's just, the position that you have taken in accordance to what it is that you believe is taking place out there. So, the article goes on to say, history suggests that President Donald Trump's new too late nickname for Fed Jerome Powell has a strong chance of coming true. It goes on to say, Fed leaders have been criticized as slow to act absent compelling data showing them something needs to be done. And it goes on, Powell is in no-win situation with threats to both sides of the mandate. And that's why he's doing the exact right thing at the moment, which is nothing, because one way or another, it's going to be a mistake, and that's coming from economist Dan North, right? So ultimately, nobody knows what the hell the Federal Reserve is truly trying to do. And if you don't have a real understanding of what it is that the Federal Reserve is doing with their current monetary policy strategy, you are going to be subject to believing and thinking about what it is that you had known from history. Like, if you go back and you study the Federal Reserve over the last, say, 20, 30 years, all the way back to the times in which that they were not really talking about monetary policy and would literally surprise markets with interest rate adjustments, most people are focused in on that. The adjustment of interest rates, or the Fed funds rate specifically, as the main monetary policy tool for the Federal Reserve. So ultimately, if the Federal Reserve is to lower the Fed funds rate, then this would create like stimulating effects to the economy. You would find that, the overall business investment encouragement with a lower interest rate environment would then start moving into employment. So ultimately, you lower the Fed funds rate, and essentially that will create jobs, right? This is the idea behind, the Federal Reserve and their monetary policy in a nutshell, right? So when they want to combat that effect, then they raise rates. So everybody looks at it this way. Federal Reserve raise rates to combat inflation. They lower rates to stimulate the economy and to ultimately try and create inflation. Raise the employment or strengthen the labor market. And that's really how most people look at it. But this isn't what the Federal Reserve is up to any longer. And once you have taken into the consideration that they are no longer conducting themselves this way, where they adjust the monetary policy or just the Fed funds rate for the monetary policy, once you stop looking at it like that, then you can start looking at them in a whole different light. And now you don't look at them as being too late or being mistaken or anything like that. You look at it as, man, they are absolutely nailing their monetary policy. So let's take it back just a little bit and understand that the Federal Reserve wants to have elevated inflation. They want elevated inflation. And this isn't something that I'm like saying, oh man, this is a super secret that nobody knows. They've said it. They said it many, 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 many times. But they don't tell it in the mainstream media. They don't tell it to the public. They don't tell it in these articles. They don't even say it in press conferences. They have, but nobody really heard it. Now, I'm going to show you where it is. Like, you can go and look at just recently. This is the full report to Congress. This was given February 7th of 2025. So we're not even talking just a few months ago. Right? This isn't like some ancient news or anything like that. This is the Monetary Policy Report, and you can go and Google this yourself. I'm sorry I didn't leave a link down in the description. I just left a couple of links down there. But if you go and just Google it yourself, Monetary Policy Report, Report to Congress, February 7th, 2025, you'll find it right away. It has this to say in it. The inflation rate over the long run is primarily determined by monetary policy, and hence the committee has the ability to specify a long-run goal for inflation. The committee reaffirms its judgment that the inflation at a rate of 2%, as measured by the annual change in the price index for personal consumption expenditures, is the most consistent over the long run with the Federal Reserve's statutory mandate. Most people hear that, and that's it. That's it. They're done. They're like, dude, you just said it. That's it. That's all we need to hear. The Federal Reserve is going for 2%. They said it straight up right there. But they continue. Right? Now it goes on to say this. The committee judges that long-term inflation expectations, not the reality, the expectations, what you believe. The committee judges that long-term inflation expectations that are well anchored at 2% foster price stability and moderate long-term interest rate and moderate long-term interest rates and enhance the committee's ability to promote maximum employment in the face of significant economic disturbances. Now, this is important to understand because the Federal Reserve is most concerned about being able to stimulate the economy during, in the face of significant economic disturbances. All right. So if they go into significant economic disturbances, they have to have the power in order to stimulate, and that comes through employment, right? Being able to stimulate the economy to hire people. In order to anchor long-term inflation expectations, right? In order to anchor long-term inflation expectations at this level, the committee seeks to achieve inflation that averages 2% over time, right? Over time. 2% over time, and therefore judges that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. Now, this is a report that was given to Congress just a few months ago. This isn't like something that's made up or hidden. They're not trying to get down to a 2% target. They are attempting to get to moderately above 2% for some time to make up for the fact that they failed to achieve the 2% target over the previous 10 years. They said it right there. And therefore judges that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. That's why everybody is missing it. This is why everybody thinks that the Federal Reserve is too late. This is why nobody understands why it is that the Federal Reserve is not reacting or reacting too slowly or misguided or whatever it is that people are wanting to believe out there, is because they are not trying to do what everybody seems to think that they're trying to do. See, everybody thinks that they're trying to go to the 2%. They're not. They're trying to be moderately above 2% for some time, and it's working. It's working. They are moderately above 2%. Unemployment is still historically low. Like, give me a second. Let me just look it up. I don't even know what the current unemployment is. Let me just see. According to the Fed, right? I mean, now I know we can look at these numbers and, oh, hey, I got it right there. And we can look at it. And right now, I mean, if you go and look at the current position, we are, according to their numbers, somewhere around 4.2% unemployment. That is obviously not accurate, right? I get it. Like, everybody will be like, dude, the real unemployment is much higher. I totally agree. Like, I don't even look at numbers like this and think about them as being accurate. What I look at them as is the numbers that they are using to conduct their monetary policy. So if you want to understand the monetary policy, you have to understand that these are the numbers that they're looking at. Like, we could say, dude, you need to look at different numbers. Well, we can. We can look at all the numbers we want. Shadow Stats comes up with the real numbers. But the problem with that is that we can look at them all day long. The Federal Reserve is looking at these numbers. So what we're going to try and figure out for their monetary policy comes from these numbers, the ones that they are showing, not the ones that we want them to look at. Right? If that's the case, then we're going to be misunderstanding their monetary policy because we have to look at what it is that they are looking at. And when you look at those numbers, they are historically low. Like unemployment, I mean, most of history has unemployment much higher than it is today throughout most of history. In fact, there's only just a couple of times, and it's way back there, like in the early 70s, late 60s, early 70s. And then again, maybe in the 50s, and again, yeah, in the 50s. So basically, like in the mid and early 50s, there was a spike of it, that ran up to 6.1 in the 50s. So back then it was pretty low. Back in the 60s was low. Maybe even in the early 2000s or so. And then in 2019, like most of history, almost all of it was much higher than it is today. And so the Federal Reserve is like, when they're looking at their dual mandate and they're looking at the unemployment side or the labor side of things, they're like, we're good. Right? We're good. These numbers are still historically low. Although layoffs are rising, although people are experiencing the pain, and this is the problem that they are facing, because this is something that I actually predicted, is that during the pandemic, when all these zombie corporations were gorging on incredibly cheap debt, when they sell corporate debt, right, and they have all of a sudden they got all this cash. And they're looking at this cash and it's like, what do we do with it? Well, you better start spending that money, right? So they're going to start investing into buildings, equipment, hiring people, right? All these zombie corporations were hiring people and there was nobody to work at the service industry. This is the problem that the economy was facing. I mean, think about it. All these jobs out there trying to hire bonuses at, fast food restaurants and all this other stuff is because of this massive amounts of gorging on incredibly cheap debt at the time, where these corporations, and a lot of them being zombie corporations, had acquired a bunch of cash, hired people, took them out of the labor force. And then when you start seeing those layoffs taking place, all those zombie corporations essentially failing and layoffs are rising, they're going back to work at the service industry. So the unemployment doesn't rise, because it may not be a good job, but it's a job. And a job means that you're not unemployed. Right? I predicted this a long time ago. This is exactly what's going down. You know what's kind of interesting about it is, considering that it's the recessionless recession that I had called that, where you were going to see corporations failing, but they weren't going to get bailed out because they were essentially already bailed out during COVID. You're going to see people getting laid off, but they're not going to see unemployment rise because they're going to go to work at the service industry. So the worst part of a recession is when corporations get bailed out and those people who got laid off lose their job and they're sitting there unemployed. But if they have a job and the layoffs are not necessarily creating the unemployment and the corporations aren't getting bailed out, then the recession is essentially not existing. There could be a recession, but the pain that people would experience from it is non-existent. Even though their crappy little job isn't what they would want it to be, it's a job and they're not unemployed. Here's something that I found very interesting. Unemployment rises into a recession. Like, you go back and you look at I'm looking at the chart right now. You can go and find this chart. Just type in unemployment, go into Google, do the Google search unemployment, and then type in FRED. Federal Reserve Economic Data is what that stands for. But if you type in FRED, right after that, anything, unemployment, you can even do building permits or whatever you want, just about anything you can imagine, the Federal Reserve has a chart on it. So go and do that. Type in unemployment, type in FRED, and go and look at that chart. And something you'll find very interesting is that the chart goes all the way back to 1950. And there's vertical gray lines. Those vertical gray lines are the recession. Now, my camera's all flipped here, so it doesn't really help to look, but I'm going to kind of show you there. This is what it looks like. Now, if you go and you look at that chart, and you're going to find that when unemployment begins to rise on just about every single occasion, that when unemployment starts to rise, it almost immediately goes into a recession. Right? You can see it, like, once it bottoms out, it is at the very bottom. The moment that it starts to tick up, it almost always causes a recession, except for this time. This is the one time that it doesn't really seem to do it. There is some other times. Where was it? Like back? No, not really. Like, pretty much every single time that unemployment has bottomed out and it begins to rise, it triggers a recession. This is the only time it really hasn't done it. And it's not because I don't believe there wasn't a recession. I believe that it was the recessionless recession. So it doesn't show up. And again, like, I didn't call it out like thinking like, wow, I didn't call it out like, man, there's going to be a recession, but nobody's going to notice it. I just noticed that all these zombie corporations were essentially had all the funding that they needed during COVID, during the pandemic. And I'm like, whoa, well, if they got all the funding and they're hiring all these people and there's nobody to work at the service industry, when those companies go bankrupt or they start to fail, the people are going to go back to work at the service industry and unemployment wouldn't rise. Like if you have all these jobs available, which seem to still be available out there, a lot of them, not great jobs, but jobs, right? Then unemployment can't rise significantly. So if it doesn't rise significantly, then most likely people are not going to be all worried about a recession if they have a job to go to, even if it's not a good job. And this is what we're experiencing again right now. This is going to continue on. The Federal Reserve is going to be making a statement soon. A new statement on what it is that they plan on doing for monetary policy going into the future. They plan on making a new statement soon. In that statement, we are going to be looking for those words on how it is that they plan on dealing with that inflationary scenario. And ultimately, I am looking for the change inside of that statement. That let me bring it up here again. Oops. It's the statement on long-run goals that they put out every 5 years or so, if I remember right. And this one, it's so funny. Like I go to look for some of these things and I can never find them when I'm looking for them. Yeah, it's always afterwards. Anyhow, they're going to come up with a new statement here very soon. And in that statement, they are going to be changing the words on what it is that they are planning on doing with their monetary policy strategy going into the future. Once that statement comes out, we are going to look at it in a much different fashion. Like, I mean, well, maybe not. Maybe it might be the exact same. Ultimately, here it is. The statement on long-run goals and monetary policy strategies. That's it. That's also known as the consensus statement. Right? And this is something that not a lot of people even refer back to, right? And this is essentially where I found and why it is that I believe that they are still continuing to keep monetary policy in a position in which that elevated inflation is the goal, right? For some time. And it says, in order to anchor long-term inflation expectations at this level, the committee seeks to achieve inflation that averages 2% over time, therefore judges that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. That's in the statement on long-run goals and monetary policy strategies, also known as the consensus statement. Looking for that to change. If that changes, then we're going to have a whole new view on monetary policy. If that stays the same, right, we're going to know that they are going to keep interest rates elevated, that they are going to constantly push for elevated inflation, and they are going to hope and pray that they continue to do that, because ultimately what they are trying to do is raise the neutral interest rate. And now, again, this is something that not a lot of people discuss, but it is their problem that they were facing, is that they were not able to stimulate the economy anymore. See, stimulating the economy with the lowering of interest rates meant that there was a position in which that the Fed was either stimulating, right, where they were like lowered interest rates and the economy was like, stimulated and people were out there spending money and hiring people and investing and doing all their things, right? They lowered interest rates. It's causing the stimulating effect. If they raise interest rates, this slows down that stimulus, right? It makes it a restrictive economy. However, if this is the sense in which that they can either restrict or stimulate, there's a position in which that they are neutral, meaning that they're not doing either one of those things. And that neutral rate was really close to zero, like almost zero. And so stimulating the economy with the lowering of interest rates was no longer an effective tool for the Federal Reserve. Now, this isn't me saying it. This was the Federal Reserve saying this, and this is a speech given by John Williams of the New York Fed. right? This was given November 30th of 2018, and he straight up said it right in there. Right? Today, we face an altogether different set of problems stemming from a very low neutral interest rate. This is a speech that he was saying back in 2018. Remember, like, we had just got done with quantitative easing. For the last 10 years, there was this massive amount of money printing, zero interest rate policy, and it failed to create an inflationary scenario for him. The low neutral interest rate was not a stimulating effect. Today, we face an altogether different set of problems stemming from a very low neutral interest rate. That is the short-term real interest rate, consistent with an economy operating at its potential alongside low and stable inflation. Ironically, the problem we need to solve these days is the risk of inflation that is persistently too low rather than too high. That's why we have higher inflation today. It's because they needed it for their monetary policy. If they didn't get it, it would have failed them. The neutral interest rate was too low for them to stimulate the economy. It was near zero. With an elevated inflation expectation, it will begin to pull the neutral interest rate up. You will not only demand a higher return on your capital investments because you believe that there's inflation coming. I mean, would you lend your money out for a low interest rate if you believe that your purchasing power was going to be lost into the future? No. If you have elevated inflation expectation, you're going to demand a higher return on your capital investment. And you're also going to expect to pay more going into the future on all the items you buy. You're just anticipating that's going to be taking place. Between those two things, it will pull the neutral interest rate ever higher. If you can pull the neutral interest rate off the lower bound of zero, then when the Federal Reserve goes to stimulate the economy by dropping interest rates, they can get well far enough below that neutral rate to actually stimulate the economy. This is what the Federal Reserve is attempting to do. This is actually how Donald Trump is benefiting the Federal Reserve by screaming out there, right? Tariffs, massive uncertainties, all kinds of nastiness, right? People's then elevated inflation expectation begins to pull that neutral interest rate higher. Again, this is not me who is saying that it was the Federal Reserve's problem. It was the Federal Reserve saying it was their problem. Again, stemming from a very low neutral interest rate, and the problem the problem they needed to solve was the risk of inflation that was persistently too low rather than too high. Okay, guys, how many minutes into this? Okay, we're going to keep it short. I got to go call bingo here before too long, so we're 22 minutes into it. We'll give it like another 10 or 15 or so. Let's cruise down here to the bottom. Well, that is not exactly correct. When California gold hit the East Coast, look at all those turn-of-the-century mansions. We were wealthy once upon a time. What are your thoughts on central bank digital currency implementation? Okay, 8 reg. What I think about the central bank digital currencies, and what I really feel is taking place going into the future is going to be more of stablecoin usage. Like, the government can regulate the stablecoin, the Federal Reserve can continue to do their monetary policy. Anything that is being backed by the dollar, like a stablecoin does, anything that is happening within the monetary policy of the Federal Reserve will then transfer right through into the stable coin. So now you have two things happening here. The Federal Reserve continues to conduct themselves the way they normally do, and government can then regulate the stable coin portion of things, because the Federal Reserve can't inject money directly into the system through like a stable coin application or through a central bank digital currency. Like a Fed coin would essentially be illegal. Like, they can't do it that way. They could change the way the charter is written, and there's that possibility, or they could just conduct themselves the way they normally do and then have Congress create laws or have government create laws on how the stable coins are going to be conducted. And then they can just do their monetary policy like they normally do and then transfer that right into the stable coin. Does that kind of make sense? Because anything else outside of that, it would be too difficult, because then you have to actually get Congress to get together and vote on the right and make it happen. And that's just way difficult. So it's going to be a lot easier for them just to maintain the way they normally do and then create a situation with the stable coins that need to be regulated by Congress. And they're kind of forced into doing it. So I see it happening that way. Ultimately, it's so that they can get cash out of the system and take interest rates into negative territory. So right now, I don't see that needed at this point, but at sometime in the future, it's going to be the case in which that they're going to want to have cash out of the system and then take interest rates into negative territory. And at that time, I mean, we're going to be so into cryptocurrencies or tokenizations and stuff like that, that it's probably most people won't even notice that it's happening. So anyway, I mean, it's already kind of happening. All failed fiat currencies are replaced with gold and silver every single time. All right. Check your local lawmakers on your local treasury. They're going to make all stocks, bonds, and your property collateral for their gambling. Big banks, secured creditors of Fed. All right. The Fed's always just done what they've wanted to. That's how they got passed in 1913 anyways. Then after that they got passed, they put all that they took out to get it passed and more. Okay. Yeah, I mean, it's a bit rambling there. Like, I mean, we kind of dive into this a little bit more coherently and try to figure it out for what the reality is, not just like, oh, hey, man, they suck, right? I mean, that's easy enough to say, but it's better understanding to dive into it to truly understand what it is that they are up to, understand their strategy. And I don't look at it as a good or bad thing. Like, I mean, ultimately, I guess it's a bad thing because I would much rather see us on a fixed currency or a hard currency like precious metals or something like that. But it's not up to me to decide that. And I mean, whatever. It's not that case. It's not that way. So I'm not going to pretend that it is or going to be. I just need to figure out what it is that's going on so I can make the best decisions for myself. I don't know about, this is coming from, what is that? Schizophrenic Economist. I don't know about the stock market. I totally am at a loss. It's been going up and down and I'm losing it. Which way do you think it will go tomorrow? I am such a I am not an investor, guys. Like, I don't know how many times I have to really say that I'm an economist. I don't look at things like, where do I put my money to get the most out of it? That would be a whole different energy and idea of what it is that I'm doing with this information. I take this information, I break it down to try and figure out what it is that I need to do for myself, because what it is that you need to do for yourself is going to be totally different from what I'm doing. Now, I've talked about all kinds of positions in which that I have taken, and I've done quite well in a lot of them. Mainly, the cryptocurrency market has done quite well for me. Coinbase, wonderful stock, bought a bunch of it when it was low, dollar cost average into it, kicked ass. Right? Same thing with the cryptocurrencies, and actually, I didn't do too bad with gold in some of the mining stocks and stuff like that. But it's not something that I encourage other people to do. Those are the positions that I have taken that I thought were pretty decent. I did quite well with Altria and the dividend payments that it had made. I didn't do well with the stock move that it had done. Like, the price of it didn't go up that much, but I got a bunch of dividend payments off of it, which was kind of cool to have. This is the way that I look at the investment, right? I have a house, that's my real estate position. I have a small portfolio for stocks. I have a 401k, right, with the employer contribution. I buy, into precious metals when I can. I buy cryptos when I can. I'm very, very, very passive, very mild when it comes to my investment strategies, and I don't get excited about anything. Like, literally, I don't get excited when I see cryptocurrencies move, which they've done quite a bit here lately. It's fun to watch. It's just like, oh, wow, look at that go. But I don't get my heart into it, and I don't think about it in a way that says, how do I use this to make me money? This is how I'm using the information, is to come out here on YouTube, talk about it, and then when you internalize the information for yourself, you take it back out there and make money with it. All right. When Trump and Powell have their sleepover, yeah, are they eating candy and playing video games all night, or slamming shots and railing lines? Oh, I would imagine, like, it's probably like a very obnoxiously different kind of like sleepover where, Trump is trying to get on the computer to look at porn and Powell's trying to play Monopoly with them, you know? You see how that kind of goes. It's like that's generally how one of the kids wants to do you know get into mischief and do the wrong thing, and the other one just wants to have fun and actually do the right thing because he doesn't want to get in trouble. You know, that's how I see Trump and Powell sleepovers. All right. White dog inherent, and then you can retire. Yeah. All right. The Alchemy of Finance, free on Spotify, 2.5 hours. Powell playing chess, Trump playing tic-tac-toe. Tic-tac-toe is hard to win. Have you ever tried winning at tic-tac-toe? It's almost impossible. Okay. I'm new here and I like the conversation topic. So where should I start with watching your content? Lamar, I'm gonna push. Thank you for asking because I'm gonna push my members only channel right now. Member only videos that I have here on YouTube. It's $1 a month. You'll have access to all the member only live streams that I've done, breaking down the Federal Reserve speeches, breaking down all this content in a way that you can internalize for yourself. So really, that's the best way to go about it, is to really become a member of the channel. $1 a month. Again, you'll have access to all those member only live streams that we have done, and you can go and look at those speeches. I've linked them all down in the description of them. You can go back and just look at a bunch of my videos, but as far as understanding this stuff to the level of what it is that I'm just spewing out here right now, you really have to study this stuff way back. This is a 20-year long study and theory that I have now developed over many, many, many years. It really started back from a Ben Bernanke speech talking about deflation and how to prevent it from ever occurring here. And so once you go back and you look at that speech and you realize their main problem that they face is not inflation, but is actually a deflationary scenario. And I know that's hard for a lot of people to try and internalize, considering how much is portrayed out there that the Federal Reserve is going to lose control over monetary policy and we'd see a hyperinflation. That is not the fear coming from the Federal Reserve. The Federal Reserve is so scared of deflation, like in a way like you wouldn't ever imagine, especially if you're worried about hyperinflation. It would make it almost impossible to understand the Federal Reserve's monetary policy because they are so scared of deflation. And it's so weird to think that, because really ultimately what got me into studying the Federal Reserve and studying monetary policy and everything is because I believed that there was going to be a hyperinflation scenario. I thought it was going to take place back in quantitative easing 1, 2, 3, and 4 during the great financial crisis. And so that's what got me really studying into the Federal Reserve, because I was buying silver believing that I was going to protect myself, and really saw that silver run up to like $50 an ounce and thought I was the smartest person in the entire world, only to watch it crash back down into the teens. And I had essentially, if I would have sold it, lost a ton of money that I really couldn't afford. I was so mad about that. I was like, why? Why did that happen to me? Like, here, I thought all the Federal Reserve's printing of money and the quantitative easing and taking the balance sheet from $850 billion to over $4.5 trillion was going to destroy the monetary system, and that the silver was going to save my life and I was going to be super rich because of it. And yet it was the exact opposite that happened. And if I was to sell my silver at that moment, I would have been completely at a loss. All right? I had to look at it way differently. I was like, okay, so it's not what I think it is it? What is it? And so as I started studying into it deeper, and I just ignored everybody out there. I said, okay, that's it. I'm not listening to anybody. I'm certainly not listening to any clowns out there who are trying to push silver with their face on it, telling me that I'm going to be saving my my money by buying into it, only to find that it absolutely went the opposite way with it, and I damn near lost everything I had. In fact, I feel like I did, except for a box of silver with some dude's face on it. And it was just like, oh, right? So as I started breaking this stuff down, I'm like, okay, I'm not going to listen to these people anymore. I'm going to start reading these speeches for myself, right? So I sat there and I read a speech, and I'm like, I don't understand anything these people are talking about. I don't know, like, I'm reading through it. It's just completely like garbly-gook. It was just like I couldn't understand anything that they were saying. So I just keep reading it, right? And if I found something I didn't understand, I would just read it over and over again. I would go and read the footnotes. I would go and research until I finally understood what it was that they were talking about. And as I started doing that with more and more speeches, and I'm talking like hundreds and hundreds of these things that I have poured through, I started realizing that they are delivering a message to each other that is different from that of the mainstream media. When I realized that, I thought, oh, that is why so many people are confused. That's why I was so confused, is because they don't deliver the message that is appropriate to what it is that they are talking to each other like. It's completely different. Is it lies? Not exactly. No, they're not lies. What it is gaslighting at its finest. It's allowing you to believe in something that they are doing that they're really not doing. Mainly, it's them trying to get down to a 2% target. You could go and find, if you type in 2% target, you would find countless articles, countless videos, countless amounts of people talking about how the Federal Reserve is trying to get inflation down to a 2% target, right? Nobody, literally nobody out there, except for maybe the uneducated economist, okay, if you exclude me, I don't know if anybody else out there is talking about flexible average inflation targeting. Flexible average inflation targeting is the monetary policy coming from the Federal Reserve. It's not a 2% target. It's 2% over time. And I mean, there's nobody who describes it better than Jerome Powell. Jerome Powell, in a speech that he had given back in August 27th of 2020, right? It's called New Economic Challenges in the Fed's Monetary Policy Review. In that speech, he talked about the 2% target, and he talked about how they are no longer going for it. It says here, the persistent undershoot of inflation from our 2% long-run objective is a cause for concern. Under the 2% objective, they couldn't get there. See, this is what I find funny about 2% target, is that never once in the history of time has the Federal Reserve ever been able to achieve it. I don't know why anybody would think that they could do it into the future. They've never been able to do it in the past. All right. People say, oh, the Fed's trying to get to 2%. And I'm like, good one. All right. Because they won't. They can't. They never have. Never will. All right. They can't get to a 2% target. Either they're under it or over it always. The persistent undershoot of inflation from our 2% long-run objective is a cause for concern. Many find it counterintuitive that the Fed would want to push up inflation. Not only do we find it counterintuitive that you would want to do it, I found it almost impossible considering quantitative easing 1, 2, 3, and 4 failed to do it. I mean, if there was inflation back then, my silver would have went to the moon and I would have been doing a happy dance, but it didn't. It went the other way and I was losing. Why? Because inflation couldn't be found. They failed. They were failing miserably. They couldn't get it. After all, low and stable inflation is essential for a well-functioning economy, and we are certainly mindful that higher prices for essential items such as food and gasoline and shelter add to the burdens faced by many families, especially those struggling with lost jobs and incomes. However, right? You poor bastards who have no money, you're going to suffer with higher prices, and it's going to be a pain and miserable experience. However, inflation that is persistently too low can pose serious risks to the economy. You see why they have elevated inflation right now is because they said it back then. If they had it too low, it would be a serious risk to them. We need it too high. John Williams was saying it, and here Jerome Powell was saying it, and he even said right then that they were going to cause pain and misery to you poor people. I mean, he straight up said it. It was just like, a real burden for those who are facing low incomes, Well, that sucks for you guys. However, if we don't do this, it's going to pose a serious risk to the economy. Inflation that runs below its desired level can lead to an unwelcome fall in long-term inflation expectations, which in turn can pull actual inflation even lower, resulting in an adverse cycle of ever lower inflation and inflation expectations. This is exactly why the Federal Reserve needed to have this higher inflation. He goes on to say this. To prevent this outcome and adverse dynamics that could ensue, our new statement, this is the consensus statement, this is the one that we are looking to see change here at the end of this summer, right? As of right now, the new consensus statement indicates that we will seek to achieve inflation that averages 2% over time. Therefore, following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. Wow, just like what they were saying to Congress just a few months ago. This speech was given back in 2020, 5 years ago. They're still going for elevated inflation. They wanted it 5 years ago, they wanted it in 2018, and they want it today. They want it today. And this is why everybody is missing it. This is why everybody gets it wrong. I don't know how many times I've gone over this information. I don't change. My understanding of the Federal Reserve and the monetary policy and what it is that I have been saying for the last 5 years has not changed. Their strategy is very much in line with what it is that I am talking with my theory. And my theory is in line with their strategy. That's what I meant to say. All right. In seeking to achieve inflation that averages 2% over time, we are not tying ourselves to a particular mathematical formula that defines the average. Isn't that convenient? Isn't that the best part of this whole thing? They have no mathematical formula for figuring out the average. Thus, our approach could be viewed as flexible average inflation targeting. Flexible average inflation targeting. It's not inflation targeting, it's flexible average inflation targeting. Our decision about appropriate monetary policy will continue to reflect a broad array of considerations and will not be dictated by any formula. That's why everybody gets it wrong. Everybody. Literally everybody. And I'm so looking forward to the new consensus statement. I'm so looking forward to it because once those words are either there or changed, I know that my belief and my understanding of the theory will be second to none when it comes out. Nobody else is talking about this, so therefore when the change takes place, I will be on it. I will be on it ahead of everybody because those are the words I'm looking to change. If those words don't change, yeah, I'm going to know that they are going to continue to push elevated inflation going into the future, and it's all about raising the neutral interest rate. It's so easy. It's once you see it, it's easy. But once you look at, but if you were stuck looking at mainstream media for the information, none of this would show up. Literally, not a single word of this would show up. All right. Let's go check out this other super chat real quick. Okay, guys, I got to go. I got to go call bingo. What time is it? Yeah, I got like just a few more minutes. Deflation did not occur in 2008 because the banks got trillions. They hoarded, bought assets, and made lending difficult. They inflated assets, not goods. That's absolutely right. There was inflation in think about the things that you borrow. Okay, here's the problem with the quantitative easing 1, 2, 3, and 4 is that most of the money ended up on the big bank's balance sheet. So if you think about it, if it's on the big bank's balance sheet, that's not out there chasing goods and services. And unless that money is lent into the system, it just sits on the big bank's balance sheet. Okay? Now, what do you borrow money to buy? Houses, bonds, stocks, right? This is the stuff that ended up getting inflated in prices is because those are the things you borrow money to buy. So that's how the new money got into it. All right, the information conveyed in Rich Dad, Poor Dad, timeless, even though the story is not true. All right, a recessionless recession does that go every aspect of the economy, not just unemployment? MWriter777, I'm going to stop using, I talk about the recessionless recession being a previous thing. That's like what had already occurred. People were looking for a recession in 2022, 2023, 2024. Here they are looking for it in 2025. I'm no longer using the recessionless recession idea. That's come to an end, that's used up. We very well could go into recession going into the future. But right now we have really, really, really low unemployment. And we have the inflation scenario right where the Federal Reserve wants it. I've proven that many times through their own words that they want moderately above 2% for some time, exactly where we are. They're in line. Everything's lined up. The Federal Reserve is looking back on, hell yeah, guys, we got it. We're doing it. Right? They're not worried. This is it. This is exactly where they want to be. Now, times will go on and things will change going into the future. Now, if they put out the idea that they are going to be lowering interest rates going into the future, that will have a stimulating effect within the economy. I mean, the people will just behave in a fashion as if those rates had fallen, especially if they have a good enough story to tell about it, right? If they deliver a message that is very well understood and heard and communicated, right? That they are going to be doing a particular action with their monetary policy to be stimulating, then it will have a stimulating effect within the economy before they even do anything. Just think about like the dot plot from the end of 2023. Totally stimulated the economy going into 2024. It was like, I mean, you saw interest rates coming down, mortgage rates were coming down, people were getting quite excited about it. And that's all they really have to do, right? They can just like communicate it out there well enough. Alrighty, guys. I wish I could stay out here and keep going, but I got to go to work because I got many jobs that I do. Uneducated economist. You guys let me know. All right. Blessings to you, UE. You've come a long way. Thank you very much. Oh, and by the way, guys, I'm going to the Rebel Capitalist. Really looking forward to that. Talked to All Nighter this morning about it. I'm gonna try and like stay down there for a little bit longer, a little bit extended stay, and hang out with my sister if I can. But I'm really excited about going down to Orlando, hanging out with the crew down there, going and visiting with the other Rebel Capitalists who George gets together at probably one of the best conventions that you could ever possibly go to, as far as like the amount of information and just sheer intelligence of people. It's just incredible to be there. It's a really good event, and I'm looking forward to it. So, all right, Uneducated Economist, you guys let me know.